In today's episode, Paul and I are going to bust the myth that whole life insurance is more expensive than term life insurance. It's actually not, and we've got some numbers to back it up.
Yeah, and we're going to talk about how one of these products is an asset and one of these products is a liability. Stay tuned, listen in to find out which one is which.
Hi, I'm Dave.
And I'm Paul.
And we're going to challenge you to transform your financial future through the principles of the most profitable business in the world, banking.
We believe everyone should be involved in two businesses, the business that you're in and the banking business. Everyday people can replicate what bankers have been doing for centuries to leverage capital and build wealth through private lending.
Join us as we uncover the truths about money, expose lies and myths, and flip conventional financial advice on its head. Here we go. And we're back. What's new, Paul?
Well, not much. So, all joking aside, Dave and I are recording this on the same day, so last week's episode was actually recorded at the same time as this episode is.
So you're saying we're out of small talk? No more small talk?
No, okay. Never. I mean, we just did a bunch. Talked about transportation and
politicians.
And docking of sorts, like a boat or whatever.
Yeah.
Anyway, so no, but I did change my shirt, so it'll appear to everybody. Well, not now, but.
Well, I didn't. I'm still wearing my football coach's shirt because it's football season now.
Right.
So baseball's over, on to football. Very excited about that. It's actually Blake's first year doing 11-man. So going into seventh grade, they do 11-man football now. So now we need an extra coach. So we got 4 dads coaching, and full up 11-man football. It's going to be, full-size field. Like it'll be fun. But we've always got new players, and all the coaches always do feedback on all your players at the end of the season.
Sure.
So other coaches know stuff about them. So we get, you always get this one who's like a phenomenal athlete. They score 4 or 5 on everything out of 5. And then they get over to attitude, and it's like a 2. I'm like, all right, we know where our problems are going to be. So, we're getting together, coaches, have a coaches meeting, figure out how to set the expectations right away up front that, hey, your attitude is something you can control. And look, if you can't control it, then, that's going to affect your playing time. Sorry.
Yeah, that carries over to the financial space. There's a lot of people that hate whole life insurance that have poor attitudes.
Yep. They just need a good coach.
Yeah,
really.
Exactly. Yeah, there's 2 right here.
They got to be coachable. So that's actually, that's one of the biggest qualities that we think makes for a good client and a good user of the infinite banking concept is somebody who's coachable.
Yes. You can't be a know-it-all.
You can't be a know-it-all. And I can't think of any clients who are not coachable. Because yeah.
Several years ago, Dave and I, when we were first starting out, we did a couple of like webinars, where everyone was working from home. So it appeared that people had an abundance of time because sports were shut down and, it's just crazy. But we ran into a couple of someone that I had invited who, aside, I've mentioned him before, but just a complete, just utter, what a loser. I'm sorry.
Jerk. Yeah.
He'll probably never hear this, but what a jerk. And he did apologize, but just
yeah, just try to derail the entire webinar and because he already knew everything. There was nothing else we could teach him, and he knew everything about whole life insurance and the process of banking and everything.
Yep,
right.
Knew everything. Just amazing.
Yeah.
Yeah.
So, thanks for inviting that guy.
Yeah, sorry.
Appreciate it.
But anyway, let's cut to the chase. So, I'm excited about this episode. This is going to be good. It's going to take people by surprise, I think, because it's not something they've heard. They've never heard this put like this.
Yeah. And the fact is, as you can tell from the episode title, you already know what we're going to talk about. But I'm going to go ahead and say it. Whole life insurance is cheaper than term life insurance. What? How in the world could that be? So, one thing we talk about when purchasing anything, there's there's two categories that fits into: a liability or an asset. So how would you relate those to term life and whole life insurance?
Right. Right. So, term life insurance generally, unless used as part of an overall real strategy, not buy term and invest the difference as a slogan. It's not a wealth building, legacy creating strategy. So, from that's the lens we're going to look at this through, folks. Right? Is that term life insurance on its own with no other comprehensive plan is a liability. Whole life insurance is something that so it doesn't make you money.
It's not
Right?
making you any money. It's taking your money
It's
and not
taking
doing
money.
anything
Right?
for you,
So,
right?
like your primary residence, like your vehicle, it is a liability.
Oh, wait a minute, Paul. You just said your primary residence is a liability? What? That
Yeah,
flies
it
in the
doesn't make you
face
any
of
money.
everything in conventional finance, personal
It
finance.
does. I know. So
Yeah.
controversial.
We could digress, but I think
Sure.
most people probably know what you mean. But the fact is, it's not paying you anything.
That's
It's
right.
costing you money, right?
Costs you money. Right.
There you go.
Taxes and insurance. Insurance costs have gone up like 23% on most homeowners policies. Read that today on LinkedIn.
Thanks,
Yeah.
Florida.
Yeah. Thanks, climate change.
Oh, it's a climate.
It's like, oh my goodness. Anyway, getting back to it, but whole life insurance, right? Whole life insurance makes us money. Whole life insurance is an asset.
From day
As
one.
simple as that. From
Yeah,
day
when
one.
properly designed, asset from day one. Yep.
Let me qualify properly designed real quick because we hear that a lot in the infinite banking concept
Right.
space. The term is thrown around there. It means something different probably to people on certain Facebook groups. They like the 1090 blend of base and PUA premium. We don't subscribe to that school of thought at all. So properly designed, let's just say properly designed for you and your family. Like Dave's policies are probably slightly different than mine. Mine are different than somebody else's, and so on. So properly designed in quotation marks. But basically, what he means is a participating or dividend-paying whole life insurance policy, right?
With a blend, typically with a blend of base premium and
PUA
paid up additions premium.
Right.
Right.
Yep.
There
Correct.
you go.
Exactly right. So anyway, with a not your grandfather's whole life because the PUA rider's not that old. It's been around since like the 90s or something. Anyway.
So if you wanted to become wealthy, if you want to increase your wealth over your lifetime, are you better off purchasing liabilities or assets? I mean, if
Well,
you don't know the answer to that question, you need to go to a different podcast and start somewhere else.
yeah, the simple answer is, look around at most people. Most people are surrounded by liabilities.
Yeah,
Financial liabilities. And I mean, like their spouse or their financial liabilities. They have your typical family. I'm looking out the window here. Everyone's got 2 cars, right? Liabilities. They got primary residence. Super expensive in this area, more than it should be. Liability, huge liability. To live in this neighborhood, Dave, right? The typical house here will cost somebody about $5,500 a month to live in. To own, and about $4,000 a month to rent.
Yeah.
Anyway, so
Plus the cost of
liability.
ownership on top of that, everything else.
Right? All the
It's
little
not making
things.
you. Hopefully, it appreciates, and hopefully,
Yep.
you get some of that back someday.
Right.
But you're right. We're not trained and taught to look for assets, or even understand what they are. An asset, if you want to use like Robert Kiyosaki's definition, which is what you use, is something that makes you money.
Right.
Something that is creating more money, not sucking money and you're saying goodbye to it forever and it's depreciating. So let's compare that now with term insurance. Why would you call term life insurance a liability then? Like, it's providing me something. I'm getting $1 million of death benefit coverage for my family, and it's really, really cheap relative to
Correct.
whole life insurance.
Yeah, exactly right. So term life insurance does provide you that pure death benefit coverage to cover, and what most people think is, as I get older and the kids leave the house, I won't need that anymore. Well, how do you know that? Well, we totally think the opposite way. But it really has no value. It doesn't have a cash value, right, component to it. There's no, you can't borrow against it. It doesn't have any, statistically speaking, term life insurance almost never pays a death benefit. When I say never, maybe 1% of the time, depending on where you read, it's probably 1 to 2% of the
Yeah.
time a term life policy will actually pay a death benefit. Actuarially, it's the same exact price as whole life insurance. It's exactly the same. The difference is the risk factor. With term life insurance, the insurance company knows through the underwriting process and through millions of lives that they've underwritten that generally speaking that they can accept those premium dollars for whatever it is. We're going to get into an example here in a second, but they can take that premium over a lifetime and never pay the death benefit. And we're going to show you those numbers here of how all these people pumping term, well, these companies are getting rich. And I often say from the military folks, think of the company that administers the SGLI, right? And let's say just for round numbers, there's 1 million people paying the SGLI premium, which is whatever, $29 a month now or whatever it is.
Yeah.
Think about that. How much premium they're getting versus how much they're actually paying out. They're paying out almost nothing on average.
Wow. And if they're bringing in $29 million a month,
A month.
how many service members are actually dying while they're in service? Right?
Not that many.
Not that many. Certainly not $29 million a month worth when the payout is only $500,000.
Correct.
So, yeah, you're right. So, what are you actually getting with term life insurance? When you think about it, you're getting nothing, period. You, the person purchasing it on your own life, you're getting absolutely nothing with term life insurance except peace of mind. Hey, and if that's all you can do right now, do it.
Yes.
I mean, if you're listening right now and you've got anybody depending on you and you don't have life insurance, what's wrong with you? I'm just going to say it. What's wrong with you? Why do you care so little about your family?
Yep, you have to have it. And one aspect of term that we like that we've mentioned before is if you can qualify for it, get yourself some convertible term life insurance.
Absolutely.
It's kind of like, term life insurance with some extra jimmies or frosting on it. Like it's better, right?
Yeah.
It's better because you can convert it to a whole life policy if in the future that's what you want to do. Anyway, so just small side note there.
It's a guarantee to upgrade anytime you want.
Guaranteed upgrade.
So
it's like going from a Toyota to a Lexus.
Yeah, there you go. So the only people who get anything would be the beneficiaries of that term policy if you die early.
Right. There's generally not a living benefit, is what you're getting at. Like I can't go out and get a loan with it or take a loan against it. Nothing. I can't do anything with it.
Yeah. Well, so let's talk about actual numbers. What is a sunk cost, Paul?
It's one of those like necessary evils, right? Like I have to have this thing. Really like a car. I mean, it's a sunk cost. I mean, you get a little bit when you sell it, maybe whatever, but it's money you're shelving out that you'll never
see again. Yeah, you'll never get it back. Yep. So let's take, for example, a 30-year-old male. Maybe he's married, got one kid, and he says, "Well, I need life insurance until I'm 60, and then I'll be able to self-insure." So he gets a $1 million convertible term policy, because that's the only type we would ever recommend, for 30 years. It's a 30-year term policy covering him for $1 million. Costs about $150 a month. Times 12, that's $1,800 a year.
Pretty cheap.
Pretty cheap. Until you multiply that by 30 years, what do you come up with?
$54,000.
$54,000. So at age 60, he's perfectly healthy. Maybe he's not perfectly healthy. In any case, at age 60, that insurance expires. It's gone. Done.
Right.
Does he get any of that $54,000 back? What's his return of capital in that situation?
$0. He gets none of it back.
What's his return on his capital in that situation? Also $0.
It's not good.
I'll just say this, it's not good. So now if he dies early, then
Meaning within the term, right?
within the term, meaning below age 60 in this example, I don't know if you can get term insurance for longer than a 30-year period.
I haven't seen.
I don't know if companies offer 40-year term insurance or anything like that.
We had some friends that had mentioned that he had a permanent term, and this was years ago, and I wasn't really familiar with. Also, well, if you ask me now, I'd say also known as whole life insurance.
You mean, well, permanent term insurance is also like IUL? You mean,
of course, universal life. Yeah.
Renewable term. So, of course, any term
So maybe it
insurance
was
is
1 year
permanent.
renewable term is what he had.
I think most term insurance, they'll allow you to continue, but they're going to charge you the 1 year renewable term at age 61.
Yeah, and it gets.
Which is
Do
going to
you
be,
have those numbers so we can mention it?
I do. We'll
oh my gosh.
get to that. I thought I did have that. It's in there somewhere. We'll stumble upon it. Oh, at 60 years old, if you want, to maintain that $1 million term insurance, probably going to start costing you about $900 a month, or almost $11,000 a year.
And then it goes up again the year after
and then
that.
the next year it's going to go up even more. So it's going to go higher and higher, and you're only going to get that level $1 million. So there you go. After 30 years, this 30-year-old male, call him Mr. Average, has put $54,000 into something that he's getting nothing in return for it.
Right.
So now we go to, what's really expensive? Putting $54,000 into something and getting nothing? Or let's go to, whole life insurance and start talking about, hey, $1 million of whole life insurance. Now that could cost you, there's a wide range based on how a policy is designed on what that premium will be. But let's say Mr. Average here was making $100,000 a year, and he said, you know what? Even Dave Ramsey even says, I need to save 10% of my income. So I'm going to save $10,000 a year. Okay. Well, next question, where are you going to save it?
It's got to reside somewhere.
Your money has to reside somewhere. So let's just put it in a specially designed whole life insurance policy that's going to pay you dividends. And we'll add some term insurance to get you up to $1 million until you no longer need that. Meaning your permanent insurance climbs to $1 million and you don't need that extra term anymore. So we could do that for about $10,000 a year. Right? That's what he's going to save. Well, guess what? 10 years from now, when he's 40, Mr. Average is going to have access to every dollar he's ever paid in premium.
Right. So he's paid at this point $100,000 of premium 10 years in, and he has access to the equity of the policy, which at this point is roughly $100,000.
Yeah, actually just slightly more. But
slightly more.
So now 10 years in, he's saving 10% a year. At age 30, that was 10%. By the time he's 40, hopefully that $10,000 a year is more like, 5%
15,
or 3%.
20.
Or no, I'm just saying that 10,000 is going to feel like a lot less because he's making a lot more, right? So maybe it's only 5% or 3% of his income. So, but at that point, he's got access to everything he put in. And guess what? He has more death benefit than he did 10 years prior, which is a good thing because is he worth more now? Does he probably have more liabilities in his life or
probably
people
added
depending
another
on
kid
him?
or two?
Yeah,
sure.
Probably. Maybe a dog. So he's got more people depending on him. Therefore, he should have more death benefit. So by age 60, when his term insurance would have expired, $54,000 down the drain, nothing back. Oh man, I made it to age 60. Congratulations. Oh shoot, my family didn't get $1 million. Oh well.
Right.
So it's kind of a, you're still alive, so that's good, but your family didn't get $1 million. But by age 60, with Mr. Average doing the whole life plan, he's now got close to $1 million in permanent life insurance that's never going to expire.
Curiosity, Dave, real quick, because I'm not looking at the same thing you are, is when does he get to that $1 million? What age? 62 ish?
Oh.
Do we have?
So he gets to that million at when that term expires, it would be age 64.
64. So he's
In this
close.
example, and again, this could be designed
Right.
so many different ways in this
Right.
example because we wanted to focus on the cash value as well. So there's always trade-offs. But yeah, so he's got 925,000 of permanent life insurance when his term expires, and it's going to quickly grow to 1 million and beyond. So let's say he lives to be 80. What's his death benefit going to be at 80 years old? It's going to be, according to this, over $1.5 million. So now his death benefit's grown. The longer he lives, the more death benefit is there. And here's a really cool part. At age 60, when
I love this.
he was putting that, $1,800 a year into term insurance at age 60. Oh, I don't have to do that anymore. So I'm basically making $1,800 a year now.
Yeah.
It's almost like, I'm freeing up $1,800 more that I can spend in retirement. Well, guess what? He'll be able to do at age 60 if he started his whole life policy. Every dollar of premium he puts in there is creating $3 in cash value. So now he puts in 10,000 and he's got access to $30,000 of cash value that year just from that $10,000 premium. And then it's all tax free. He can access it 100% tax free.
The haters are going to find that unbelievable. And the reason that is, of course, is because they don't know anything. But it really is like that, folks. In year 30, like Dave just said, every dollar in premium will produce 3 of cash value, or 3. It adds a factor of 3 in the equity of the policy. So 10,000 creates 30. And it gets better. This is the only thing, like, not the human body, not your car necessarily, not your house. This stupid whole life insurance product gets better with age. It's more efficient with age.
And you know what's cool? If he decided only to pay the base premium, which a couple years later he can only pay the base. So let's say the base was like $5,000. He's paying $5,000 and getting $30,000 increase in cash value. So now he's getting $6 for every $1 he puts in there in premium. I mean, the base portion of the premium gets so ridiculously efficient. Even after like 5 years, it gets incredibly efficient.
It does. Not to talk policy design, but I had a client that recently asked for an 80% base policy and a 20% PUA, and we might have mentioned it before. And because he wanted more death benefit right out of the gate, and that's how we provided it. And he asked for that particular. And this is a smart guy. He's an engineer and he's a listener. So, Brent, good on you, man. But it's someone who gets it, and I think I have talked about it before. But it's someone who understands the power of the base premium.
Yeah.
Base premium later, especially, is everything.
Yep.
In the policy. Anyway, I'll get off my soapbox.
We're all about that base. Might even
I'm
be
all
an
about
episode.
that base.
Might even be an episode titled that.
Yeah, it is an episode. Yeah.
Yeah.
Yep.
So, and then what at age 60, if he wants to stop paying his premium altogether, he can do that and still be growing his policy by ridiculous amounts.
Yep.
Every year.
Yep. Yeah. So what Dave's talking about, folks, is, and I think we've discussed it as well, but it bears repeating in case you're a new listener, maybe and just jumped into the latest episode. But whole life insurance has non-forfeiture options, right? Where as the policy matures, you do have the ability you could use the dividend to pay the premium. You could take a policy loan to pay the premium. You could do something called premium offset right from the outstart. We don't recommend that, but you could. You could do what's called a reduced paid up, an RPU of the policy, where you stop paying premium and your policy is paid up. It will accept no more premium, but the policy will still grow. It'll still receive the annual dividend if declared, and it's great. So it's not this like, oh, I got to pay until I'm 100 or 121. You should want to. I'm going to pay premium till the day I die, most likely.
Yeah, right.
Unless I live past 100.
Oh yeah, and then you're just gonna party.
I'm gonna party like it's 1999.
Let's spend all that cash value. Yeah.
And a raspberry beret, maybe. That was
I know.
Did you get? Okay.
Yeah, I'm from Minnesota.
Oh, that's right. He's from there.
Prince Rogers, I'm not from, I live here. Prince
You live
Rogers
here.
Nelson Highway I drive
Right.
it every day.
Right. If
Yeah, I
anyone
go,
didn't know that reference, sorry.
yep. Then, yeah, pull your head out of the sand and listen to the radio.
Yeah.
So, so really, do you want to purchase your life insurance as a liability or as an asset? There's two ways to purchase it. So it's
Yep.
up to you. And it all starts with getting educated, understanding. Last episode we talked a lot about the process. This episode we're talking a lot about the product. So it's a healthy mix that you need an understanding of.
Sure.
More so the process, but the product. You need that understanding to really, you know, to get to the point of saying, yeah, this is for me, and to know how to use it. And
Yeah, and if you have doubt about the product, Nelson Nash does a great job in his original book, Becoming Your Own Banker, of really going through the methods of financing a vehicle purchase. All right, and he takes you all the way from paying cash, financing it using a CD, all the way through the even a banking concept, and
leasing it,
financing with a
yeah,
dividend, and leasing, which is the worst way.
yeah,
So he shows you how doing, and you could apply that to anything, right? House, education, investments, cars, whatever you're going to finance, which is everything. Finance everything you buy.
yep,
Anyway, so if there's any doubts, he lays it out there in black and white. It's very simple to understand and very
yep,
obvious.
yeah. And then, of course, you can always schedule time with me and Paul. There's links in the show notes and the website, thewealthwarehousepodcast.com. You can find some training videos and scheduling links to get on our calendar. Typically, I think like we'll have both calendars on there. Paul's going to be early mornings and evenings, and I'm going to be work hours. So take your pick, and maybe you'll get both of us.
5:30 a.m. Let's go. Eastern time.
Eastern time. So man, if you're on Pacific time, just get up in the middle of the night. Schedule time with Paul.
That's right.
Yeah.
That's right.
Yeah. All right. Well, I think that's pretty good. So there is, when people say whole life insurance is more expensive than term insurance, ask them, what do you mean by that? Like, how much is that term going to cost you over your lifetime? Are you going to get any of that money back? I'd say something you put your money into and never see a dollar of it again is pretty dang expensive.
Yeah, no question.
Yeah, especially to have nothing to show for it 30 years and 1 day later.
It's truly a sunk cost
Yeah.
because there's no equity, right? It's not like buying a car or boat. You get something back from that depreciating asset, right?
Yeah.
With
At
term,
the
you
very
get
least, you could light it
nothing.
on fire and watch it burn. That'd be kind of fun.
Yes. Yes, you could.
At the very least. So you get something out of that,
Right.
even an old rusty car. But yep, you'll get nothing. Not to say if you don't have insurance, get insurance,
Yes.
even if it's term. Make sure it's
Even if it's term.
convertible. But yeah, we've got plenty of episodes on talking about convertible term and the importance of that. But yeah, hopefully we help kind of bust that myth that everybody just says and takes for granted that, oh yeah, it's more expensive. So you don't
Yep,
have to
and-
defend that if people are telling you, why would you put your money there? It's so expensive. You can kind of turn the tables.
One caveat is the numbers that Dave used today that he was referencing. We just pulled those numbers today.
Yeah,
Of a
and
real live life insurance illustration with one of the companies that we write business for. So, yeah, the term and the whole life. So
Right. So, and again, those could be designed 100 different ways. So don't take it as gospel if you're 30 years old and you call us up. So it's going to, because every case is going to look different. Every policy is going to be designed differently, specific to the individual and your needs.
Right. And, one parting shot is, and maybe this is just a very simple way to say this, is that, the reason that term is cheaper, it appears cheaper, first off, right? It appears to be cheaper. But again, if you need the numbers, reach out, we'll send them to you. But in the end, we just showed you that it ain't.
Nope, not if you think long range.
Think long range.
Well, there you go. All right, everybody. Hope you enjoyed. Have a great week. We'll talk to you next week. Until then, control your capital.
Or somebody else will.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle on a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.